Why you should be leery of the 60/40 portfolio. I'm Bob Stokes with Elliott Wave International. Many investors allocate a percentage of their portfolios to bonds to cushion against a drop in the stock market. A popular allocation is a 60/40 mix of stocks and bonds. However, this hasn't worked out recently. Here's a Yahoo Finance headline. The 60/40 strategy is on pace for its worst year since 1936. The mix of 60% stocks and 40% bonds was down 19.4% from the start of the year through the end of August, according to Bank of America Global Research. Specifically, the S&P 500 declined more than 16% through that period, with long-term treasuries sinking more than 20%. Investment-grade corporate bonds were down 13%. Investors who thought bonds would provide a degree of financial safety may not have been aware of Elliott Wave International's forecasts. Indeed, back in March 2020, our global market perspective showed this graph of yields on global bonds, 10-year U.S. Treasury notes, and U.S. general obligation municipal bonds. Here's the commentary. According to 150 years worth of data, this is the first time that 10-year Treasury note yields have dropped below 1%. Grand Supercycle to Greek tops set Grand Supercycle records. Investor ebullience is the only thing that allows for an embrace of no-yield debt. The tidal wave of risk assumption, however, may be turning. In other words, expect the downward trend in yields to turn upward. Shortly after that March 2020 analysis in our Global Market Perspective published, yields began to climb, meaning bond prices began to sink. In fact, on September 13th, yields on 2-year U.S. Treasuries jumped to their highest level since 2007. On the same day, the Dow Industrials registered a 3.94% decline. Speaking of stocks, here too, our Global Market Perspective provided timely warnings. Our December 2021 issue stated, junk bond yields should rise while stocks decline. The wave principle suggests that the era of spaceflight for financial assets is over. The Dow Industrials hit a top a month later. Not every forecast based on the wave principle works out to a T. However, the Elliott Wave model is the best analytical method of which we know. See what the wave principle suggests is next for major financial markets in the U.S., Europe, and the Asian Pacific by following the link below this video.